Good stuff.
Okay, good morning, everyone, and welcome to the disability meeting for March 2016. Let's make our introductions for the record.
Good morning, everyone. Rosemary DeBellis, representing and designee for Commissioner Bratton.
Good morning, Susanna Vickers, designee for Controller Taxpayer.
John Dorsa, alternate designee for Controller Training.
Bill Duke, designee for Commissioner Finance.
Carolyn Wilford, designee for Mayor de Blasio.
Keith Snow, Law Department, present by invitation.
Joe Alejandro, designee for Patrick Lynch. John Puglisi, Mubarak Abdul-Jabbar.
Chris McGrath, PBA by invitation.
Joe Rayo, PBA.
Mark Reno, PBA invitation.
Gary DeRosa, alternate designee for Ed Mullins.
Bob Ganley, SBA designee for Ed Mullins.
Nick Safuni, President as Counsel, SBA, LBA, CBA by invitation.
Steve Brigade, designee for Lou Turco.
Roy Richter, CEA.
Marty Williams, DEA by invitation.
Kenny Sparks, DEA, designee for Mike Palacino.
Karen Paxis, DEA by invitation.
Sherry Chan, City Actuary, present by invitation.
Eli Kleinman, Chief Surgeon by invitation.
Bob Shensky, State Pension Fund by invitation. Kevin Holleran, Pension Fund by invitation. Brian Berge, New York City Law Department by invitation.
Amy Okereke, Law Department by invitation.
Amy Donnelly, Medical Division by invitation.
John Benoit, Medical Division by invitation.
Therese Gallagher, Medical Division by invitation.
Nicole Chambrisi, Police Pension Fund, present by invitation.
Diaz, Pension Fund by invitation.
Mike Jakubowicz, Police Pension Fund, present by invitation.
Diane Carr, Pension Fund, present by invitation.
Pension Fund, present by invitation.
Lisa Garcia, Pension Fund, present by invitation.
Aisha Winham, Pension Fund, present by invitation.
Okay, Joe.
All right, page 1 to confirm the next meeting date, Wednesday, April 13, 2016. Article 2, pages 2 through 12.
Nothing of a controversial nature, Joseph. We're going to so move that.
Thank you, Kenny. So moved. All right. Pages 13 through 24 recommend enacting safeguards provision of Administrative Code 13-254 for police officer Rachel Nicole.
I received a memo from the Chief of Personnel indicating that police officer Nicole may no longer be disabled. An investigation revealed that she participated in 40 marathon triathlon events over the last 6 years. So therefore, I would like to remand her to the medical board for examination pursuant to the safeguard statute.
And I understand by process, this will go from public session to executive session. I am going to submit new medical evidence today. I want to be very certain and sure that that medical evidence is submitted through the executive session because of HIPAA protections with regard to her personal medical records.
That's fine. I have no objection. I think that's a good idea.
Thank you.
Okay.
All right. Page 25, resolution regarding checkbook NYC.
Yes, this is the resolution that we bring to you. We'd like to extend
We could put the booze on the record, by the way.
participation in Checkbook NYC for the next quarter ending June 30th of 2016.
Has the page visits gone up by like 2 or 3 in the last quarter?
About 2 or 3.
Okay. All right. I make a motion that we accept the recommendation for 3 months, and we'll revisit the issue then.
Thank you.
All right. Okay. For 3 months. And pages 26 through 49, resolution preliminary fiscal 2017 employer contribution.
Thank you. The preliminary fiscal year 2017 appropriation is $2,293,839,525. This is a decrease of about $100 million from the updated preliminary fiscal year 2016 appropriation. A majority of that was due to asset gains and salary gains. The asset gain, even though we incurred a asset loss for fiscal year 2015, we're still rolling in some gains from the prior years. So in net, we have an asset gain. The salary gain represents the contracts being lower than what we had expected. I do want to point out that the mortality component, which reflects the mortality assumptions that I proposed in December and was adopted by this board in January, that component is basically flat on. It was 0.04 actual death was 0.04% from what was expected. So I think we made a good move in adopting the mortality assumptions. I'll be happy to answer any questions.
No, is there a time matter with this, timeliness matter? Is it possible to table this one more month? We haven't had a complete review of it, and just
We
like a
have
little
the
more time.
latitude to table this, yes.
Okay. I appreciate all the effort, and we'll like to just look at it one more month, and so table the matter,
Okay.
and then we'll review it for next month's meeting.
Okay.
Thank you. All right.
Okay, that's a table.
The table. Okay, and a budget police pension fund fiscal year 2017 on the handout.
Okay, you should all have a copy of the budget in front of you. Obviously, we're not expecting a vote, we just want you to review it, and we'll set up whatever meetings we need to discuss.
Kevin Howard, 43% increase, Jesus.
So keep in mind that we expect to wrap up this whole process to choose a vendor for the upgrade. My concern is that we will probably finish up in December, maybe early January, and I want to run with momentum, and hopefully we can put some money into the budget to start the process and not have to wait purely because we don't have the money until July. So I ask you to consider that, and again, we're open to discussions. So as soon as everyone's ready, we'll try and put something together and have a meeting to discuss further.
Okay, all right, thank you. All right, so I think going through the agenda, I'd like to make a motion that we go into, I'd like to make a motion that we go into executive session for purposes of discussing members' disability cases.
Second.
All right.
Okay, break down cameras. All right, anybody
Bob
else?
Ganley. Go ahead, Bob Ganley, proxy for CEA.
John Adler, representing Mayor Bill de Blasio.
Leanne Lung, here by invitation.
Okay.
Everybody else is here.
And there are two speakers.
Andrew Junkin with Wilshire Consulting, I presume I'm here by invitation.
Rob Asling, Wilshire Consulting, also here by invitation.
Okay, with that, Scott?
Okay, thanks very much. As we promised you, we would come back to you with some initial thoughts about asset allocation. Our consultant here at Wilshire is going to take us through. We're trying to pick up just where we left off with SIS. There's a little backing and forth thing. Wilshire looks at things a little differently, and so we're going to start here. We're going to stick with the low-cost portfolio on the one hand and the fuller-cost portfolio on the other, and Wilshire will take us through the pros and cons of that. And then Sherry will take us through what the different risks mean, like in terms of what the different risks mean in terms of required contribution, what the effect would be over time from the different allocations. But the idea here is to get you guys to come to consensus and express a preference for either the low cost path that would not include alternative asset classes, or the higher cost path that would include alternative asset classes, which would be more similar to the asset allocation that you have today. This is an exercise we're going through with all 5 boards, and if you very firmly feel one side or the other, and you tell us that today, when we come back, we'll just come back with that path. So with that, why don't I turn over to Rob and Andrew to start the presentation.
First of all, thank you very much for having us here. And, as I think Scott, to emphasize the point that he made, Wilshire, we're obviously thrilled to be working with all of you, but we are coming into this process sort of middle of the way through. And so to the extent you want to see something different from us or in a different format, or you have some feedback on this presentation, please by all means let us know, because we can completely customize our presentations into what you want to see and what you don't want to see. And what we've done here in terms of asset allocation is try to keep it very high level in nature. I think it's going to be important for us to talk for a few minutes about how we come up with assumptions for expected returns and expected risk for different asset classes in our approach, and then specifically go into the objective of the analysis, which is to compare a low-cost, more traditional asset class portfolio with a higher-cost portfolio that includes exposure to alternatives. So if that works for everybody, maybe we spend a few minutes talking about our assumptions. And forgive us if we don't mean to make everyone squint your eyes here, and I think we've got print copies coming soon. But essentially, what you're seeing on this slide is expected returns for the primary asset classes for institutional portfolios over the next 10 years. So as you might imagine, equity, private equity, fixed income portfolios, and private capital and real assets and real estate, among others. And with Wilshire's philosophy is multifaceted in terms of the engineering and creating these assumptions. For just to give you the 30 seconds on kind of equity. For traditional equity markets, we use a two-pronged approach. We use your traditional dividend discount model to come up with one assumption of expected returns, and then we also use an income growth and valuation model, which looks at where are we at in this current market environment versus valuations historically, and we look at both of those approaches and combine those together to generate an expected return for equity. For fixed income, for lack of a better phrase, fixed income is traditionally easier to model because you know that the yield that you're going to get off of a bond is primarily the return that you're going to get over the next 10 years. So if the 10-year treasury is yielding 2%, you're probably going to make 2% over the next 10 years. And so we look at yield, where they're currently at for fixed income. And then we also look at spreads. To what extent can those spreads change estimated valuations over the next 10 years. As you might imagine, that comes into play more so with some more opportunistic credit like high yield bonds. So what you're seeing here is the expected returns for those asset classes. Let's see if I can zoom in here a little. I think is that the handout? Oh, okay, fantastic.
No, I'm free so far.
Okay,
That's
fine.
What?
So the lesson that we've learned is we're going to bring handouts in the future.
Yes.
I just want to confirm that the expected returns here are geometric returns,
Yes.
not the arithmetic.
Yep. Geometric returns. That's important. The question is, are these geometric returns? And the reason why that's important is that takes into account compounding of returns over time versus just an arithmetic return. The other thing that's important about these assumptions is that they're over a 10-year period. Now, the reason why that's important is because we think it's going to be a very challenging market environment over the next 10 years. What do we mean by that? Well, until the recent 6 months or so, 9 months, we've had essentially a strong momentum-fueled, liquidity-fueled bull market since the crash in 2008 and 2009. And equities are, depending on what metric you look at, are either fairly valued to slightly overvalued. Then you combine that with historically low interest rates. I know the Fed had their lift off in December, but we're still operating in an interest rate environment that's still very, very low. And so if you combine, a 50-50 or a 60-40 portfolio of equities and fixed income, you're looking at expected returns around the 5-6% range, which is very challenging, as you might imagine, for our client base of institutional investors who are trying to get 7.5% returns in their pension plans. I know that is the bogey that we're looking at when we did this analysis. Is it possible to get to a 7% return over the next 10 years? And we'll kind of get into that as we look at our assumptions. But without making you squint your eyes, if you look at equities, it's about 6.5%. Expected return over the next 10 years. Core fixed income is 3.5%. And so going back to that same idea that I just mentioned, you combine those two asset classes together and expected returns are relatively muted. Now, so what institutional investors have been doing, or say a trend over the past 10, 15, 20 years, which also applies here today to the police plan, is looking at alternative asset classes outside of the traditional equity and fixed income to generate better risk-adjusted returns. Things like private equity, hedge funds, as you all know. Private equity, interestingly, is our only number on here that's above, close to double digits. Private equity is about 9.5% right now. So if the goal is to generate, a 7% return over the next 10 years, 15, 20 years, it's very difficult to do that unless you're able to lock up some of that money in liquid investments like private capital. Any questions at all about sort of the,
So your equity assumptions for all three publicly traded is steady at 6.5%, with a higher risk when you go from U.S. to IFA to emerging markets. But emerging markets have, been in the pits for the last few years. And so I would think that the valuation, the price to earnings, however you're doing it, would be substantially lower for emerging markets than for U.S. equity, which, as you said, has had this momentum-fueled bull market really since 2009.
Right.
So why?
Yeah, so to answer your question, first of all, you said we have the same assumption for U.S., non-U.S. emerging markets. I think that's a very important point to highlight. We would argue and submit that over a longer-term period, 10 plus years, there will be parity between those expected returns of those different asset classes, but we do look at current valuations. And so to your specific point on emerging markets, while emerging markets have been beaten up over recent periods, we don't think the valuation differential between emerging and developed is large enough to where we would have a premium for emerging markets relative to developed equity. So while we agree with you, we just don't know if that spread, that difference, is large enough at this point to increase the expected return for emerging markets.
So I would take that to mean that, that you would recommend that all of our publicly traded equity be in the U.S., unless you feel like the correlations justify going with some allocation to international or emerging markets, where it's high risk.
Yeah, so this is another good question of saying, if you're going to have the same expected return for U.S., non-U.S., and emerging markets, really what's the point? Why not just have U.S. equity and take some of the risk out of the portfolio by not investing in international markets? I think this is where you have to look at the quantitative side of portfolio engineering and look at these numbers, and you also have to have a qualitative side of engineering a portfolio, sort of the science balanced with the art of portfolio construction. And so while we think the returns are going to be similar, there are some diversification benefits to having U.S. and non-U.S. equity in a portfolio, to where you can get some beneficial correlation between those two asset classes. The other thing I would submit specifically about emerging markets is this is going to be the growth story over the next 20 years. While we've had, in the near term, a slowdown in China, global growth is going to come from these emerging economies that have stronger balance sheets relative to the ones in developed non-U.S. and even here at home with the amount of debt that the Federal Reserve and Treasury put on their balance sheets after the crash in 2008, 2009. So there's our scientific numbers, and if we did this in a vacuum and went asset class by asset class, you could have a debate on this asset class versus this other one. But I think it's also important to think about some of these qualitative factors as well when you're constructing the portfolio.
I would just add, when we think about equities, because we do have the same expected returns, can everybody hear me, or should I stand by the mic? When we think about equities, we really think of it as a way to profit from global growth, global economic growth. And so with a similar expected return, I would not say put all of your money in domestic equities. I would say absent the basket clause, you should just be fully global. You should be agnostic to where the equity exposure is so that you can capture global GDP. The basket clause sort of changes the game, right? That you can't do that. But we think that the global opportunity set is really the most diversified approach to capturing the driver of returns there, which is economic growth.
Honestly, I still find it curious that your expected returns are exactly the same, that you basically get no premium based on this from taking on the added risk, particularly of emerging markets.
Yeah, it's by design. I mean, it's not happenstance that they ended up that way. Because we do view sort of the global equity marketplace as the neutral beginning point for most clients that don't have that kind of restriction that you do. If you say, well, emerging markets are likely to either grow fast or they're at such a valuation level right now that they have to have higher returns going forward. That's making a statement that you can properly value the world's equity markets in such a way that you know where the outperformance is going to be. I'll tell you, our returns go out to 2 decimal places. We're not that precise. Right? They're wrong. We'll stand up here 10 years from now and we can tell you then where we were wrong and by how much. But right now we're kind of focused on what's the process to get us to an effective portfolio that balances risks properly but allows the portfolio to grow, driven by a number of different economic sources.
Just before that, I just want to add one other point. The second bullet point up there that says these return expectations are just beta, just market exposure. They don't incorporate any alpha or outperformance by an active manager above their benchmark. And what we would argue also, just talking about emerging markets, that's more fertile ground for alpha relative to U.S. equity markets. And so while alpha is not guaranteed, obviously, we think that would make more sense in emerging markets than in the U.S. as well. Sorry, go ahead.
Yeah, just correct me if I'm wrong, but if you take these geometric returns and convert them to arithmetic returns, there is a risk premium when you go across asset classes.
There is, and international is higher and emerging is higher than that in arithmetic.
Yeah, I mean, mathematical.
Yeah, that's right.
So the point was, these are geometric returns, so everyone can hear that point, and if you had arithmetic returns, those would be slightly higher. The other thing is, just so that, I think I made this point earlier, but just to emphasize that these are 10-year assumptions, so that's why, given the challenging market environment, they're lower. We also produce 30-year assumptions. Our client base tends to utilize those numbers more for comparison to their actuarial rate of return, given that the actuarial rate is based on a much longer time horizon than, say, a market portfolio construction time horizon of 10 years. But for the purposes of this exercise, and for the purposes of us making recommendations to our clients, we use the 10-year number because we feel that's the most accurate, call it, window of being able to properly value asset classes and make return expectations going forward. So I know we might spend more time on our assumptions than we wanted to, but I will tell you we also have a white paper that we produce every year. These are updated quarterly, but every year we kind of go into more detail, about 10 or 15 pages long, goes asset class by asset class. So Friday night, Saturday night, if you guys want to read more about our assumptions, we'll be happy to send that to you guys. Okay, so let's get right into the exercise. And so what you're seeing here, I think, thank you so much for printing those copies, and as Andrew said, lesson learned. But what you're seeing here now on this slide 3 is your current target asset allocation in gray, and then we provided some alternatives. And what we've done is used the comparison of the low cost or traditional asset classes like equities and fixed income. And then we've also used the high cost scenario. We've kind of done this along a risk return spectrum. And what I mean by that is if you look at the low cost, we've engineered this portfolio along the efficient frontier to have a similar return from what you're using today. And then for the alternative portfolio, the higher cost portfolio, we've engineered that along a similar risk as what you have today. So why do it that way? Well, what we would argue, and I'm sure this is not going to be a surprise to anybody in this room, is that we believe alternatives can generate higher risk-adjusted returns. And so if you're going to have this exercise and you're going to say, what is the trade-offs, what are the benefits and considerations of having a low-cost portfolio versus one with a higher cost, we would say those trade-offs are essentially risk and return. So I'm happy to go asset class by asset class, but just to kind of get to the point, if you want to look at the very bottom section of that, where you can look at the median returns and risk, you have a expected return according to the assumptions that Andrew and I spoke about just a second ago, a median return of 6.47% and a standard deviation associated with that return of 11.76%. So we tried our best to match that expected return on the next column while also eliminating exposure to alternative asset classes, alternatives like private capital, hedge funds, those kinds of things. What you see with that exercise is we can get close. That's actually the end of our efficient frontier, the very on the risk spectrum of 6.41%, but essentially the same return. Call it 6 basis points. Andrew said earlier, you start going out to 2 or 3 decimals in terms of expected returns. But the core message here is the first column in alternative 1 are essentially the same expected return, but the risk increases by 196 basis points. And so the story here is we think we can generate a similar type of return using lower asset classes, but the risk goes up substantially. It goes up almost 200 basis points or 2%. And we discussed that more, but essentially that's a way of saying is that a prudent amount of risk to be taking versus where you're at today? And then alternative 2 now does the reverse here. If we keep the risk constant, is there an opportunity to increase returns or have higher risk-adjusted returns from where you're at today? Alternative 2 does that, albeit marginally. The Sharpe ratio increases from 44 basis points to 47 basis points. So alternative 2, a higher cost, same risk portfolio, has the same standard deviation with about a 24 basis point increase in expected return. That's how you get to your higher Sharpe ratio. A couple of highlights in the asset classes of alternative 1 and alternative 2 there, the middle 2 columns. Our assumptions, we use an optimizer to this. We have some constraints on the next slide. The constraints were put on this to make these portfolios reasonable and implementable. What we mean by that is, I believe, Scott, this is our 3rd or 4th iteration of this deck, and when we first did this, we put 0 constraints on the portfolio. And the optimizer wanted 28% in private equity. Well, 28% in private equity is great for a PowerPoint presentation to show higher expected returns, but not necessarily reasonable or implementable for an institutional portfolio when it has 7% in private equity. So we don't have to go line by line on the constraints, but just kind of giving you some idea that we put some reasonable constraints around this to something that we think is implementable.
I should note that Alex Dunier did think that was a reasonable allocation. Alex said private equity. Everybody else thought it might be a little extreme.
Okay, fair enough. And what you'll also notice on, just to point out a couple of highlights here, on alternative 1, the lower cost, same return, if you just look at total growth assets, it's 85% of the portfolio is in growth assets. Now, does that mean 85% equity? No, because we're categorizing high yield fixed income at 10% as a growth asset. So this is obviously can be debated, the merits of both sides, but the fact is that high yield bonds in periods of market distress can behave very much like equities. The correlations are higher relative to a really true risk-reducing fixed income asset like core bonds or treasuries. And so we would categorize your opportunistic fixed income portfolio, your high yield portfolio as more growth oriented or having more growth risk than really a risk reducer or volatility hedging asset. So then goes back to the qualitative aspects of putting a portfolio together, or maybe even a gut check of putting a portfolio together. Do you feel comfortable with 85% of your portfolio in really growth or risky investments, and only 15% of the portfolio in core fixed income? So you can play this numbers game with expected returns and expected risk, but we would argue that's not a prudent asset allocation, or another way of saying that, we think there's other opportunities elsewhere to enhance risk-adjusted returns rather than just saying we're going to lower costs and go 85-15 and call it a day. A couple of other points here, and then I'm going to let Andrew talk about the last two portfolios here in terms of the changes there. The other piece of this is private capital. So I mentioned earlier that private equity, they've optimized, wanted 25-28% in private equity. Private equity still goes up from 7 to 10%, and real estate also goes up as well, 3% from opportunistic real estate into 5%. So another piece of a way of generating those excess returns, we think, is in private capital. And the last thing I'll mention is just the absolute return and some opportunistic fixed income. Those are also higher relative to where you're at today, because we think those are diversifiers for a portfolio relative to your traditional asset classes. So before we talk about the last two those include a new idea we'd like to broach with this group and have more education around. Just introduce it today is on low volatility equity. But before we do that, is there any questions about the methodology that we used here, or how we put this together, or just the results of the presentation? Yeah.
When you do your optimized portfolio, are you using geometric returns or arithmetic?
It's geometric.
Okay.
Any other questions? Okay, I think that lunch is starting to sit in a little bit, so I'm going to turn it over to Andrew. The last two portfolios talk about an idea we'd like to share with you on low volatility.
So you actually stumped me with that question. I think the answer actually is we optimize with arithmetic returns and then reconvert it to geometric.
Okay, yeah, actually, so your initial response stumped me, because typically with efficient frontier, it's the arithmetic return.
Right. So I think that the arithmetic return actually drives the frontier that you see, but then we always present geometric returns.
Yes.
But that's stuck somewhere way in the back of my head with other pieces of information that doesn't get called on all that often. So I don't know, have you all discussed low volatility equity strategies in the past? It's a pretty simple, this is not another version of hedge funds. It's a pretty simple, long only equity strategy that is, come back up, that's really focused on minimizing the equity risk that's present, the drawdown risk. So instead of being focused on something like market capitalization, instead of being focused on something like market capitalization, where companies that have lots of shares outstanding and are trading at high prices get the biggest weight in your portfolio, the weighting scheme is determined by what's going to push the risk down as far as it can. Now, we've all learned over the years that higher risk equals higher returns. But that's actually, and that's true from asset class to asset class, as you saw with our assumptions earlier. Lower risk asset classes have lower returns. But within the equity markets, that's really not true. There have been a lot of studies that go way back to the 60s that prove that the security market line, which is, that line that we think goes up and to the left, up and to the right, up to the right, where you take more risk, you get higher return, is actually pretty flat. And so what that says is, by taking more risk, you're just taking more risk. You're not getting higher return. So you can construct a portfolio that simply owns equities. It's not a balance of equities and cash. It's not a hedge fund. You're not shorting anything. That's just focused on risk first. That can take about 30% of the volatility out of an equity portfolio. So this does pretty predictable things to that portfolio. In really strong rising markets, it's very likely to underperform. In very strong down markets, it has typically held up pretty well. And then in the middle, in kind of normal markets, it essentially holds its own. So we did a study, and this is a couple of years old, but it's the data that I know, where we looked on a monthly basis at the low vol equity index versus the traditional index. And in the best 20% of monthly returns, there were 56 of them. Low vol underperformed in 53. In the 20% of worst months, it outperformed in all but one month. And in the middle, it was essentially a dead heat. It was a tie. I think low vol had a very slight advantage of like a couple of months, and the returns you had to go out to 2 decimal places. So what does this mean, though? It means in times of market distress, you've maybe taken a little bit of the equity drawdown risk out of the portfolio. You're not forced to liquidate assets to rebalance at low prices, things like that. You all are essentially cash flow neutral. The distributions are roughly equal to the contributions coming in. A lot of plans are not. They're cash flow negative, and this becomes a much, much bigger issue then. So as the plan evolves and is likely to turn cash flow negative at some point, as all plans do, this could be a different path. So we included low vol equities. It can be something as simple as an index fund by active managers. It's easy to implement.
Can I ask a question about low vol?
Yeah.
Is there definition? Is the definition like the lowest volatility names in the index, or is there a volatility threshold that it has to be below? How do you define it?
Well, so there is one magical portfolio called the minimum variance portfolio. And when you run an optimizer, you can find the lowest volatility portfolio. The problem is it's very sensitive to the assumptions that you make. And to get to the true minimum variance portfolio, you take all the constraints off and you end up with a portfolio that looks a lot like 70% utilities. It's almost a corner solution. It's not something that you would want to have. So the way people get around that is they constrain that optimization. And so I happen to know the MSCI index rules for low volatility because I've done this enough. So sector weights are plus or minus 5%. So you can't end up with a portfolio of just bank stocks going into 2008, which would have been awful. The true minimum variance portfolio going into 2007, I believe, was heavily weighted in Japanese equities. It's interestingly heavily weighted in Japanese utilities, and one in particular that owned the Fukushima reactor. Would not have worked all that well, and so you have to put guardrails in, right? So the volatility of that company, of that stock, was really low, but without putting some guardrails in place, you introduce a risk that a model can't capture, right? So most implementers are looking to reduce whether it's an active manager or an index fund, looking to reduce total volatility by about 30%. So you see beta come down to 0.75, 0.8. But they've got those guardrails in place, so you don't end up constrained into one particular sector or one particular country if you're dealing with non-US. So that's included in 1A and 2A. Now, when you kind of get down to the bottom line, does it make a huge difference? It really doesn't at these weights. We're talking about 6 basis points in a reduction in risk for 1A versus 1, but a pickup of return of about 6 basis points. Both of those are directionally correct, but remember I said our forecasts are wrong. That's probably within at least it's headed the right way. 2A then, again, kind of a 3 basis point pickup in expected return from 2. So looking at those numbers, the question that I'm sure you're all thinking is, why would we do this? My answer is, volatility is not the only measure of risk that you're going to face in a world. And so when you encounter markets like 2008 or encounter markets like we've seen really kind of volatile in the last year or so, this offers some protection that you're not going to feel otherwise. Right? So this is one state of the world. The median case is kind of the middle of the road. Things are okay, not great, not really bad state of the world. Low volatility introduces an aspect that helps protect the portfolio in drawdowns. And at the end of the day, what you really need to focus on is how do we compound our way to the greatest amount of money in the plan, because that's what pays the benefits, and not the greatest return. Return and wealth are linked, but they're not perfectly correlated. And in some cases, the path of returns has a lot to do with how much wealth you end up with. The smoother the path, the fewer decisions you have to make at sort of crisis points, I'm going to call them crisis points, but extreme levels, positive or negative, right? So we are advocates of low volatility despite these numbers, but there may be more education that you need out of this than I've been able to accomplish in the last 6 minutes. Any questions on that?
Okay. Just to kind of round out the last few of these slides here, I'm sure everyone's familiar with the old efficient frontier charts here. And I think this, at a very high level, further demonstrates the benefits of having alternative assets in the portfolio, hedge funds, private equity, private real assets. Overall moves the efficient frontier to the top and to the left is where you want to be. And no surprise that I was able to do that with these other alternatives. And then to Andrew's point, albeit marginally, the low vol portfolios also do that at very incremental points. But again, you have to keep in mind this is only 7% of the total portfolio. That's why I don't see the needle move a lot. I think
go to the next page just for 1 second.
This one?
No, next one. No, I'm sorry. The table with the returns.
This one?
Forward.
This one?
That one. Okay. Excellent. So
this one.
I'm sure on the record that looks great. This one? This one? So I do want to point out, though, the difference here, including low vol in the very pessimistic outcomes, right? So, it's I've got to compare.
So while you're looking at that, this is a Monte Carlo analysis where we're looking at best case, median case, and worst case. And, we run 10,000 iterations of the portfolio in terms of what could happen, and that's what you're seeing on this slide. Sherry's going to dovetail later off this in terms of what that means from an actuary standpoint.
Yeah. So including low vol does sort of truncate to some extent the worst case scenario that we would expect over a 5-year period. If it goes out even farther, it gets to be a bigger deal. And Sherry's going to talk about this, but 0.5% or 1% is a lot of money that somebody doesn't have to contribute to the plan or is available for benefit payments.
That would be the city.
That would be the city, right?
Oh, some of our members contribute? What's going on?
So, you can do the math and you think, 0.5%, not that big a deal. $200 million, kind of a big deal, right? So if you have the opportunity to sort of truncate the downside, and I don't know whether I just walked into a political minefield or not. I didn't mean to. But,
I'll let you know. Don't worry about it.
Yeah. But obviously the bigger jump is from the sort of low-cost portfolios to the diversified portfolios, right? That's where the bigger bang for the buck occurs in terms of mitigating the downside.
And there's the last point we'll make, and then we'll sorry, Scott, go ahead.
No, go ahead, and I'll follow your last point.
Okay, just 30 seconds. Last point I'll make is to dovetail off of what Andrew's saying. When you're trying to get a 7% return, now you're really at the further end of the risk part of the efficient frontier, and you're starting to get very marginal increases in return for a significantly amount more risk. And so that's why we think if you're trying to get that 7% over a longer term period, and that's the goal, another reason why we think low volatility makes a lot of sense, is we still think you can generate equity-like returns, but with a fraction of volatility. Sorry, Scott.
Okay, that's a great lead, and just leave that slide up there. So it all boils down to this. We're at the red right now, and you got the return going north and south. You got the risk going east and west. And off to the right are the low-cost portfolios, 1 and 1A. For argument's sake, right now, you look at them both together. We can get basically the same level of return in the portfolio, but we're taking more risk. Or we can spend a lot of money on managers and get a little bit more return for the same level of risk. That's all 2 and 2A. But the question is, how much risk? What's it all mean? Standard deviations, you're looking at returns over years. It doesn't translate into something we can all understand in our everyday lives. But we're about to get to something when in interacting with Joe. how much money has to be contributed into the plans? How different is that contribution? The person that makes that translation is our actuary. And Sherry's now going to take you through what does this mean in real dollars in terms of outcomes under extreme scenarios looking out over the next 10 years. And so why don't we turn it over to Sherry?
Would you want me to go up there?
Use the mic, that would be great.
Okay. I don't think I have the presentation.
I have your Excel sheet you sent. Is that helpful, Sharon?
Is it, well, no, because they have a handout. Can you put
Okay.
back on your presentation on slide 3? I think it is. Okay, so what my job was to do was to help you understand a little bit better about what these variations mean. You see the standard deviation on the bottom, you see the returns. You might be asking, what do the 11, 12% standard deviation will translate to? And so if you look at the handout that was passed out to you about 1 page, it looks like this. This is stating it in terms of the change in contribution, which might be a little bit more familiar to the board. What my office did was we took the first 3 portfolios to the left, so the current portfolio, alternative 1 and alternative 2. And based on the returns, we modeled the mean return, which is the 2 percentile, and we also took a kind of a best outcome and a worst outcome scenario. So if you look at the handout, I can walk you through what this means. We compared these scenarios to what would happen in the 10-year period. 10 years from now, the cumulative pension contributions that the city, society is responsible for, is $23 billion on a cumulative basis. And that's if we earn 7%. So if you look at the policy target column, and you look at the middle box right here, you see a 6.5% return from the median scenario, which is the same as the 6.47% in orange on this slide right here. So if we had that portfolio, we're assuming that we would earn 6.5%. We took the 6.5% over a 5-year period, and then for years 6 through 10, we used a 7% return, which is our normal actual assumption rate. Then at the end of a 10-year period, we would see the contributions increase by 2.4%. Why we did a 10-year period, why we looked at a 10-year period was because of our smoothing on our actual asset value methodology. It's a 6-year smoothing period, so for 5th year of return to be really reflected over time, we needed 5 additional years for it to be reflected, and that's why we looked at 10-year period. So if we, the 6.5% will be falling short of our 7% return, and that's why we will see a 2.4% increase in contributions. I'll just walk through another scenario for you really quickly, and I won't go through all the numbers because it's all the same. So if you look at the same column, the policy target, in the 95th percentile, which is a very optimistic outcome, we're going to assume a 15.4% return in assets per year. So if we assume that for 5 years and then 7% thereafter, our contributions will go down about 35.6%. Because we're earning over a 7% return, you would think that we need to contribute less. The bottom portion of my handout, that's just the cumulative return over 5 years. So if you got a 15.4% return on an annual basis for 1 year, over 5 years, at the end of 5 years, you would have 104.7% return for 5 years. I'm not going to go through every number because it's the same process. Is there any questions about how to read my handout?
Well, the big question I have
Yes.
is in that bottom box.
Mm-hmm.
Speak up down there, please.
Sorry, in the bottom box, in the very pessimistic outcome.
Yes.
Because I'm really looking at worst case scenarios here. So I think what you're saying is that if we had a very pessimistic outcome,
Mm-hmm.
that the under alternative 1, the low cost, the cumulative returns would be 14.6% less, and contributions would increase by 46% over the 23 billion.
It's not 14.6% less, that's the cumulative return.
Right.
Right. That's actually a return, so that's if our assumed rate is 7%, that's 21.6% below what we're shooting to target.
But what?
So that would generate us a 46% increase in
contributions.
10 years.
So basically, over 10 years, instead of 23 billion, we're looking at approximately 34 billion.
Yes. Yes.
And on the other hand, if we had the very pessimistic outcome, it would be 7.4% below the 7%, right? And the increase in contributions would be 39% over. So even though it's a much worse investment outcome, the increase in contributions, instead of being roughly 11 billion, would be like 9 billion or something like that. I'm doing that off the top of my head.
I just figured out. So the bottom line here is, if you look at Sherry's numbers, you take the low cost approach. That's just stocks and bonds, no alternatives. We're going to spend 23 billion. Sherry says we're going to spend a little bit more because we can't quite get 7%. It's like $500 million more over the time period. But just let's start with 23 billion. If we use the low cost, it's 46% more, so it's 10.6 billion more than the 23 billion. That's the low cost. That's the risk. If things go bad, that's what happens. We have to spend 10.6 billion more, contribute 10.6 billion more than the 23 billion. If you use the diversified portfolio, the risk comes down, and that 10.6 billion becomes 8.9 billion. So same assumptions that things are bad, but it's just an extra 8.9 billion versus 10.6 billion. So the difference, that's what you're getting for your difference in fees. Now you don't actually pay extra money for the fees because the fees come out of the returns. But
so that's my question.
Yeah.
So we're looking at in the very pessimistic outcome, which in the very pessimistic outcome, we're looking at saving 1.7 billion over 10 years.
Correct.
And that's 170 million per year. Although it wouldn't work out that way, but that's what the straight math is. What will the marginal increase in cost be for the diversified portfolio versus the low-cost portfolio?
Well, remember, there'll be no extra cost because the costs are already taken out of the returns. Everything that these guys have showed you is net of the management fees. So
well, that's not true because they are showing us index returns, not alpha.
In the case of the private asset classes, which is the difference between the two, I believe they're showing you median returns, which would be net of manager fees.
We would consider true alpha net of investment manager fees as well.
So there's more complexity, John. There's extra costs for BAM, and I'll at the SIM I will talk to you about the extra costs. There's extra costs for consultants. There's extra costs for BAM staff. There's extra back office costs and so forth. And the manager costs, despite the fact that the manager costs are much, much higher, the manager costs come out of the returns. And so there's no incremental cost for the returns. There is the question of there's some boards are uncomfortable paying that much to managers and question whether the managers are sharing enough with them. And we've been through that in detail. And I do think there's some issues in how much the managers share. But these guys have used the existing lay of the land. They haven't assumed we're going to be in the top quartile. They've assumed we're sort of in the middle of the private equity distribution, in the middle of the real estate
300 at a premium of 300 basis points.
So on
sorry?
At a premium for private equity of 300 basis points over their assumed rate of return for public equity.
They assume that they can get 300 basis points of extra return, correct?
Which we have never achieved.
I think you'll find that in the that the police, and this is, we're in public session still. So you'll see at the March sim that you'll find that the police have achieved close to that, not quite there. We'll show you a slide of that over time. But the police would have, the police and fire have some of the best results in private equity, but they're better than they were a couple quarters ago because of recent results, but not quite to 300 basis points.
We're like the thoroughbred getting held back in the race. That's what happens. Now let us go. Now let's do our thing.
So I just wanted to clarify, I think our assumption on private equity is not purely median net of fees. I think there is some assumption. A median net of fee private equity program is probably not worthwhile engaging in.
Right. I agree.
And so I'll have to pull out the paper to figure out sort of what interpolation we're making in terms of we don't say it's going to be top quartile. What we say is private equity is actually levered public equity. So we apply leverage to our public equity assumption. We assume a cost to that leverage. And so we're trying to get at the actual economic fundamentals. But I think our investment research group has said, what does that really translate to? And it's kind of top third or so net of fees.
And so we're, just to translate, particularly for the mayor's office.
They need crayons, that's what it is.
No, that's not what I meant, John.
We're only kidding.
No offense taken.
Okay. Some of our other consultants make less ambitious assumptions.
Right.
And what these guys are doing is effectively making the same sort of assumptions that we do when we have a target premium of 300 basis points. As you know, our own benchmark is that we shoot for 300 for some of the same reasons, because the extra leverage, the illiquidity. And ROCA time, for instance, for teachers, is assuming median returns, which is why their premium is a little lower. And I think that's the difference in the two. I didn't mean that you couldn't understand it. I meant that I just wanted to clarify.
No offense.
All of this talk about fees made me think of one other issue is that do fees represent an opportunity cost? That is, if we take those fees that we're paying and had invested it in non-alternative assets, that would be an additional return to us, right? Additional gains that should be, that if because we spent it on managers instead, we're not achieving those gains. How does that factor into that?
I think that would not factor in as much into this analysis as to the individual manager selection analysis. I mean, ultimately, what you're talking about there then is the quantitative and qualitative analysis of making individual investment manager decisions, because I think there's hedge funds out there that are worth 2%, and I think there's hedge funds out there that are not worth 2%, and I think that's where you have to come in and have a thorough due diligence process to make sure that if you're going to pay 2%, you're going to get significant alpha net of that 2%.
But it's not extra money that you would have to invest. It's if we assume we're getting 7% from our private asset class, the manager, let's just say, earns 10%, takes 3% for themselves, and leaves us with 7%. And these guys are assuming 7%. So the money, if you hadn't invested in the private asset class, there would have been no 3 to give the manager. So you would have gotten, if you get the same 7 in the equity market, you'd be indifferent. So the part that we've argued about with the private manager costs is what's the split? Is it if we're getting 7, how much is the manager getting? Because if the manager gets out of 10, if the manager gets 3, okay, that's not reasonable. But what if the manager gets 7 and we get 7? That's not a good split, and we don't have transparency about that. And so what our whole transparency thing has been is to show what the gross is, so we can see what the split is, and that our participants are getting a fair share of the total return. But there wouldn't be extra money to invest.
But that also goes to the issue then whether we have the leverage to get a better split whether you're able to negotiate a better deal. And not putting it all on you, but essentially that's the role that you have, is that you have to, find a way to get a better deal. If you can't, whether you can maybe get other institutional funds out there to kind of jump in and leverage our strength somewhat. And it's becoming
absolutely
lesser and lesser every day. It seems like as systems go out of defined benefit.
Yeah, but it's you're absolutely right, Joe. And we pool the resources of all five of the systems to create our purchasing leverage in the marketplace. And while we don't talk to other large systems about price, we do talk about transparency and that sort of thing. And we need to be able to show the 10 to understand that what portion the manager's getting, and that's what the fee transparency thing's been about. And every day we're talking to managers about ways to get better deals and better structured deals for the New York City pension funds. We've been very aggressive about that, as have other large systems. And we have not been in a point in the market where we've had the ultimate leverage. I think we're moving more into a place of stronger leverage, and we will exert that leverage.
I will now touch on another issue, all in conjunction with this, where there is a somewhat of a problem when we put our funds together to get the leverage. Part of that is we're not necessarily performing at our most optimal. For example, and I've said this to others, and I don't want to say it in a sin because it would create an uproar, but the problem here with that is when we're all in it, then we're not getting maybe, like I said, the best performance. I don't want to just be a little better on the margin than my other four other funds in the city. I'm looking to be as maximum as possible on our fund. And does that mean that we're all earning the same funds? Maybe we shouldn't be. That's where we're supposed to be picking differently somewhat. But when we're all getting kind of wedged into the same fund, then our performance is all going to be the difference will be very minute. We'll all be around the same. And that's the problem I have. I mean, you're going to be a different investor than I am. And I'm going to be a different investor than our facilitator at some point. But the point here is, that's where we got this issue. And so I've always had this problem where we all get wedged into the same funds because the difference is going to be minute. And I'm not saying it's a bad thing. For lack of a better term, it's a lazy way of investing somewhat. We don't go out, we don't really dig out and find funds that we feel are the best. We're just going with this fund, and then we've all got room to get in it. And like I said, performance is the same, and the differences are minute. And I have a problem with it. Not to say there's an easy solution to it.
Right.
I get it. I understand, and I'm not calling you lazy. I hope you don't take it that way.
Exception to
No. Don't. But that's not what I'm saying. I think it's a way. It's problematic for our fund, and I'm only looking at our fund. I'm not looking overall at everybody's fund.
So let me say, as your investment advisor, and we are also the investment advisor to the other four funds. There's a major benefit in some private asset classes, most notably private equity, but also in real estate. I am currently getting you much better terms than you would get if I were just out, negotiating for the police pension fund by itself. And everybody's getting better terms, but particularly the police, fire, and birds that are the smaller funds because of the presence of the two large funds. And I pull them together, I'm able to get you much better terms. When we have a situation where you're willing to take risks or you're willing to go into areas where the other funds are not, and I'll use China and emerging markets as an example. We don't hesitate to continue to invest, how the police and often police and fire have a similar attitude toward this. We don't hesitate to do it. But in those areas where the other funds are not with you, it's tougher for me to get a good price. So I do think, actually it's not the lazy way out at all, it's a more complicated way. The best thing for us to do is when there are mutual interests to try to get the maximum leverage from the collective systems, but not to shirk away from the opportunity to meet your investment objectives, even if the other systems don't happen to share the lens that you put on it. So we're happy to customize where we can, but I think it would be against your interest not to pool with the other systems.
And it's a good counter to it. Or what I'm trying to, and I don't want to fully explore that. We could explore that. We could explore that another day. The point here is that when we're just outperforming each other on a margin, very different. That's not necessarily good for the beneficiaries of this fund. And could we do better? Yeah, you're right. We were getting better terms, but maybe we could be selecting better managers too. And while I'm saying that we're getting wedged into this because we're getting better terms, maybe we could find another manager that would just work with police and get a better performance out of it. That would be a counter to that ultimately. Or you wouldn't get maybe better terms, but you get a better performance on it. What I'm saying is, at the end of the day, those are things that we're looking at.
Yeah, I understand your perspective and your desire for the police to have the highest performance.
And that's the way it should be.
But you got to understand that I have 5 clients. I treat all those clients equally, and when I have a manager that's appropriate for all 5 clients, I give them pro rata access. I really can't play it any other way.
And at the end of the day, I'll just finish. That may be a problem. I'm not saying you're a bad guy. I'm just saying that in and of itself could be a problem from the perspective of a trustee on this fund. And I'll leave it at that.
It's the assignment I've been given.
No, I hear you.
Let's go.
I wanted to ask a couple of questions. And some of this is informed by what's been happening at the other funds. You guys don't talk about long treasuries. 2 of the consultants at the other funds are proposing a significant allocation to long treasuries. And I would just, and I know Scott is working to set up a meeting among the consultants to talk it through. But I would like your perspective. You just have a core fixed income allocation plus the opportunistic fixed. But in terms of core fixed, your perspective on long treasuries.
Yeah, I'll start.
U.S. government's watching.
Great. I think it depends on what role you want long treasuries to play. And my understanding of what's going on with other consultants in the industry, and I don't disagree with this at all, is that they're contemplating using long treasuries as a way to hedge some of the equity.
That's correct. I think that's what we've heard from the other consultants.
Yeah, and
you're trying to do that with the low vol.
Exactly. We try to get at that here in particular because of the cash flow status of the plan. We try to get at that equity dampening, that volatility dampening through low volatility. The treasuries in some ways are an indirect tail risk hedge, right? You could have a tail risk hedge. Instead, they're very expensive. They have a payoff pattern that tends to cause people problems in that it's like fire insurance, except optional, right? Fire insurance were optional on your house. After you paid it for 20 years and you've never collected, you'd probably give up. The same thing happens with tail risk hedging. You pay, you think this is never going to work, take it off, the market crashes, and you think, why did I do that? So the hope is that long treasuries are a way to get that hedge without having to pay and maybe having some positive return along the way. The problem is you have basis risk, right? There's no guarantee that when the equity market declines, the treasury market is going to hold up well. I would say if the issue that you're really trying to address is liquidity given an equity market decline, maybe you're better off just holding cash. The return isn't significant, but if the issue is how do we make benefit payments for a couple of years or a year, maybe that number is small enough that you're just better off holding cash. But here, because you're cash flow neutral with this plan, we feel like there's plenty of liquidity in the assets that you have. The core fixed income does some of what the long treasuries are intended to do in terms of diversification of equity risk. And the low volatility, frankly, does some of that volatility dampening that the long treasuries would do anyway. If we were not in this room, if we were in a different room talking to a different one of the funds, we might have a different answer. And I think that's entirely logical to Joe's point, and I think Scott would probably support this. I don't mean to put either of you on the spot now that I've said that. different plans can have different asset allocations based on the cash flow structure of the plan.
You also have more tips than others do for some of the reasons that other folks have U.S. Treasuries, in that you all have a negative correlation for tips, and because of that, your optimizer and your recommendation has more Treasury protected securities than you would find in the others. So it partially mitigates the difference. But we're gonna sit down. John put his finger on exactly the place where there's pretty substantial difference of opinion among our 5 consultants in how to construct a portfolio. Everything else, there are a lot of similarities, and it's everybody's using the same process and so forth. But the assumption on U.S. Treasuries and the degree to which insurance can be provided with U.S. Treasuries is a big difference. And Wilshire is somewhere in the middle of the argument. We have extremes on both sides, and it's a very interesting debate. We are going to hold it. I think we've scheduled it for the last day in March. I'm not sure if we finalized the date. Trustees are welcome. It's going to be a very technical discussion. May make your head hurt to listen to all the mathematics, but you're more than welcome to come and listen in to the debate. We'll have all 5 consultants there. The BAM staff will be there. Sherry, if she wants to attend, and then any trustees that want to listen in.
So, second question.
So you'll send out an invite to the trustees?
Yeah, absolutely.
It could be as exciting as a contested Republican National Convention.
That might be interesting.
Make the pensions great again.
Making Kelly a moderator, I like the convention.
Yeah, my second question, and this won't surprise Scott either, because I have asked about it at other fronts, is in some ways you guys are presenting us with all or nothing portfolios here. The low cost that's completely publicly traded, and then the higher cost, which has all the alternatives. But all alternatives are not created equal. Unlike all men, as long as we're making political.
We're all like snowflakes. We're all different.
And so, like, for example, in your assumptions, I see opportunistic fixed has a return assumption of 6.35 with a risk of 10%. And opportunistic real estate is only 10 basis points higher, but with a much higher risk of 17.5. And it doesn't strike me, just glancing at it, that the correlation is all that different to most of the assets. So in that case, why wouldn't we increase assets, leaving aside implementation issues? Why wouldn't we increase assets to opportunistic fixed and diminish allocation to opportunistic real estate? My broader question really is, could we do an asset allocation that included some alternatives, but not necessarily all of them, in order to, generate a higher risk-adjusted return, but with less cost?
So, a couple of questions there.
Just a few.
Let me start with the alternatives piece, because I think that is maybe the simplest one for me to answer. When you say some alternatives, but not other alternatives, the asset allocation is important with alternatives. We know that from a total portfolio perspective, asset allocation will drive 90% of your results, your risk and your return, right? I think that's based on your empirical data. We've been preaching that for years, right? In the alternative space, you can basically throw our asset allocation assumptions out the window because everything this hinges on manager selection. Right. There's a wide range of results between the best performing private equity manager and the worst performing private equity manager. There's a wide range between the best performing hedge fund and the worst performing hedge fund. And U.S. equity, it shrinks. Right. In emerging markets, even emerging markets where there's opportunities for alpha, it shrinks. Okay? So we can have assumptions for private equity, we can have assumptions for hedge funds, but at the end of the day, the success of any program is going to be completely dependent on your ability to source the best performing manager. So, and to answer the question, I would be a consultant and ask you a question right back and say, do you think we can get access to the best managers? Do we have due diligence process in place to do that? If the answer is yes, then I wouldn't exclude hedge funds for being hedge funds or private equity for being private equity. I would take a holistic approach and try to source the best managers possible and do that in an opportunistic way. Meaning, we're not just going to throw money at private equity because you know what? It's our pacing schedule. It's time for us to commit X dollars to private equity, so we have to invest with someone. I think you want to say each decision point is this a right man? Is this going to fit and add value? Because one, the fees that you're paying, and two, just the whole idea of building a successful program. All right, so I'll get off my soapbox on that. The other one that you're saying is about opportunistic fixed income versus some other asset classes. We also have the basket clause. So I think this might look different depending if there were changes to the basket clause, because our understanding is every dollar that goes into fixed income takes every dollar that goes into opportunistic fixed income takes $1 away from another asset that could be potentially subject to the basket clause. So it's not, hey, do you like opportunistic fixed income better than real assets? It's kind of that now going back to that art of putting a portfolio together, given the unique constraints of the portfolio as well.
Well, but the point is that if we increased our allocation to opportunistic fixed income at the expense of, say, private equity or another alternative, that's actually not going to have an effect on the basket because they're all in the basket. And so, what does affect the basket is if you increase the allocation to international, where every percent above 10% goes in the basket clause. But, if all the alternatives, correct me if I'm wrong, but all the alternatives essentially go into the basket.
Except for real estate.
Real estate is...
First 10% of the real estate are free.
Okay.
Including opportunistic real estate.
Okay.
And 25% of the high yield, from what we understand, and I think the lines get blurred pretty quickly between opportunistic fixed income and high yield. We're actually using some component of high yield assumptions in our opportunistic fixed income. So, we have the numbers and we have the science behind it, but you have to put some amount of art in the portfolio construction too. And to your point, this is customizable. So if we want to show sort of not an all or nothing, but we want to show something in the middle that maybe has less liquidity, because hedge funds have a better liquidity profile than private capital, we're happy to show something like that. So,
well, I've asked for that at other funds, and I think it'd be useful to look at it here.
Yeah, so what we've done is to use different pairs of alternatives to answer the mayor's request. I mean, John, as you know from the other exercises, the best solution is going to be accomplished, the best risk-reward trade-off is going to be accomplished by including all alternatives. And just as when you exclude all alternatives, you go from 2 and 2A all the way over to 1, as you begin to exclude others, you're going to move in that direction. And these guys could put together some graphs that show as you begin to peel off the alternatives in the order of which is the least harmful. What happens to the portfolio all the way till you get back to the low cost portfolio. You could do that. That might be
what you'd see on that page.
Sorry?
And that's exactly why I pulled up this page.
Yeah.
Every layer you strip off, it's going to move from blue closer to gray.
And you're going to, depending on the assumptions these guys have built in, you're going to, it's going to be a different sequence of which asset classes come off. But to the point that Andrew and Rob just made, the incremental return and risk assumptions for the various alternative classes in something that has as wide a distribution as private equity does, for instance, you kind of drive a truck through. And so there's a desire, and this is why we're getting the same result from all the consultants, to, if you have them all, you have the best chance of capturing something that looks like the line as you begin to pull asset classes, any asset classes, but particularly wide band asset classes like private markets. As you continue to start to pull them out of the lineup, you quickly regress your risk reward potentials, and the accuracy starts to fade away as well. But we can do it as we did in teachers. Teachers, we build it up the other way from the low line to the high line. I think when we did that, we didn't get the benefit of the optimization. And you know, first of all, if the board's interested in this exercise, I would argue, John, you should do it the other way. And I'd take the advice of Wilshire to basically figure out, do the optimization, figure out which alternative could you pull off entirely and minimize the movement of the line, if you will, and then do that sequentially until you've removed them all.
I mean, I think it'd be useful, and I also think that, you know, one of the things that we've seen at some of the other funds is that, you know, I think yesterday we heard from one of the consultants that once you get beyond 4 asset classes, the individual marginal effect of adding one is minimal. You know, and it could be that the marginal effect of adding all of them makes it, you know, not minimal. But if you take 1 out or 2 out, the negative effect is minimal. So I think it would be a useful exercise to look at that, and then the board can decide, does it want to, because look, here's the other thing that I would say, as you said, there are some costs, even if these are net fees. And I do think that our record in New York City of picking the best managers is, let me say, checkered. That we don't always pick the best managers. And frankly, it's impossible to always pick the best managers across asset classes. And so, and as you said, that has a huge impact on private asset classes. In the public asset classes, it's minimal. The dispersion of returns between top quartile and lowest quartile is not that great. But in the private capital markets, it's a big deal. So,
yeah, I mean, if the board, you know, wants to pursue an intermediate solution, we can come back with another analysis. If you're comfortable with you know, the full asset class and really the maximum trade-off between risk and reward, which is shown by the top line, you know, it's a question that now, to John's point, I'm sorry, some of the other boards are very interested in that. They're very concerned about specific alternative asset classes and the fees that are paid to them, and other things. And so we're highly interested in that, and we can certainly provide that for the board if the board wants to see that. But it will be, and you know, I think the folks from Wilshire can confirm this. It will be a compromise of risk and reward trade-offs, just like the low cost is from the optimal solution, which includes all the alternatives.
Yeah, I think that one thing I would note is there's probably some directional information that we can take from this table, knowing what the constraints are, which are on the next page. So, you know, which asset classes are hitting upper or lower constraints depends on where you are, but the upper constraint for opportunistic real estate is 5%, so you can see in alternative 2 and 2A, it's hitting that. The lower, that's the upper constraint for core real estate as well. It's not hitting it there, it's hitting the lower constraint in 2, but not 2A. Opportunistic fixed income is hitting the upper constraint of 7%. Private equity is hitting the upper constraint of 10%. Now, if you really wanted to make it interesting, I would suggest instead of, well, the problem is it becomes unimplementable. If you really want the answer, take the constraints off and let the basket clause be the only constraint. But you may get an answer that says it's 25% private equity and nothing else.
No, I don't think that's useful. Right.
Exactly.
I don't think that's useful.
And so we set the upper constraint of private equity at 10%, knowing that's going to take years to get there.
Right.
If we get a 25% answer, it's worthless. Right. So I mean, we can do as Scott said and kind of strip them out one at a time. But I think it would clearly prefer, if all things being equal, more opportunistic fixed income, more opportunistic real estate, more private equity. Absolute return is not hitting a constraint, by the way, hedge funds.
Right, one of the things I wonder is whether, the absolute return is really intended to dampen risk more than drive returns. Like your return expectations, as I recall, are still below the 7%, I think, for hedge funds.
Yeah, so this is, I don't really want to
$5.95.
Too granular with this stuff, but it's a hedge fund basket. So you can't just say hedge funds and all hedge funds are the same. Some folks don't even use the phrase hedge funds anymore. They call them marketable securities or absolute return or something like that. The point here is you just can't say hedge funds and plug it into the portfolio and say off we go. What is really the role of hedge funds in the portfolio? I mean, is this for growth? Is this to generate an absolute 7-8% return, or is the goal, like you're saying, to reduce risk, to have low correlation to equity markets, or some combination of the two? So when you look at a hedge fund basket like we have here, it's really a function of how much you have in long-short equity, how much you have in global macro, how much you have in equity neutral, and so on and so forth down the line. So this is a typical hedge fund basket, but it may not be apples to apples to how your current hedge fund portfolio is positioned or how it's being positioned going forward. Just sort of in sidebar conversations, from what we understand, the goal is what you're saying, is to be more of a risk-reducing, absolute return type of strategy, a very endowment-like type of strategy, meaning interest rates are still very low on fixed income, so how can I reduce risk in the portfolio without having to use very low-yielding fixed income, which is historically the role in most endowment foundation portfolios for hedge funds. But so that's I'm not trying to get too granular.
So one of the things I would wonder is whether your allocation to low vol equity plays some of the role that in the other funds who don't have an allocation to low vol equity, the hedge funds as a risk reducer may play. And again, some of the other funds are looking at more treasuries to do that, which you guys are not. So that's why I'm interested in this, stripping out. And I wonder if your optimizer, if you did take out hedge funds, would increase the allocation to low vol equity to play that role. And is there a constraint on low vol equity? Like I noticed that your low cost has 5% and your high cost is 4%.
I think the optimizer, when we unconstrained low vol, wanted 20-25% of the equity portfolio to be in low vol, and as a new idea for this group, I don't know if that's implementable or reasonable at this point. You're kind of going into, your question is, I think you're kind of going into kind of low vol 2.0 and talking about smart beta, and you could call low vol a smart beta-like strategy, and you go even further and say, is there a way to replicate hedge funds using smart beta and having risk-reducing equity exposure without paying the fees associated with hedge funds? And so I'm trying to constrain Andrew right now so that he doesn't talk for 2 hours about smart beta and all the benefits of it, but that's something we would like to have an education session on. I think there's a lot of merits to the conversation you're talking about, but I don't know if we can do it in 10 minutes.
I guess
Please, no.
And I didn't sit through the feasibility meeting this morning either. No, I think what I'm looking for is just an exploration of what these alternatives might be, instead of the all or nothing that you guys presented today. Anybody on the board?
Okay, well, considering it's not taking action, any other questions we'd just ask them as we go along, if anything you want to adjust or model or anything like that.
So if I could just say, I'd like to just thank Wilshire for pulling this together. I know that you guys, your contract started a little bit later than some of the other existing consultants. I just feel compelled, though, just to say on the record, as the person that actually by default, I guess, is right now sitting for the controller's office. Some of the comments today about how the controller's office as an investment advisor interacts with the boards. I just don't like the mischaracterization that anything that's done by the controls office is lazy and that we're not putting as much effort as we can into every decision that we bring before the board. And I just want to say this exercise, I think, is a great example of how the controls office isn't being lazy. The last asset allocation was done in 2012. With 4 years later, we're re-engaging with all of the systems, including the police pension fund, in order to come back and bring you guys better products. And the way to do that is to set up a framework to do that. So I just want to say that, you know,
You're not lazy.
As somebody who sits on multiple boards, and that right there qualifies me as not being lazy, I just want to say that, you know, we take every care when we sit here to make sure that we're doing the right thing for the police pension fund, the members and beneficiaries and retirees, including with the recommendations for the S allocation. So I just think it's important to say that on the record. So
And I wanna echo that. I apologize if what I said was construed as saying that the controller's office is lazy. They're not lazy. What I'm saying is that from the perspective of being a trustee on this fund, when we all get wedged into the same investments, and the return, it may not be differentiated much from each investment. It creates a problem for the trustees. We should all be, on each of our funds, looking for maximum return for our particular fund. And I'm saying when we don't have variety in terms of what's brought before the boards, then we have this issue where it's kind of, on our part, we're not being as proactive as possible to make sure that we're getting the maximum return for the beneficiaries of this particular fund. I shouldn't be looking to maximize the fund return for teachers who are fired. That's their job. That's what they're supposed to do. Supposed to look at the maximum return for members of this fund. And to the extent that we're all the same box, or, like I said, very minuscule return differential, could be a problem. But I hope that you don't take it as I'm saying you guys are lazy. I don't think so. At least today.
All right, so do I hear a consensus to follow John Adler's suggestion and come back with some other portfolios that are somewhere in between the two, low cost and high cost, alternative 1 and 1A and 2 and 2A? Would the board like that? Is that the next step for Bama? I just want to be
We're all for homework. It's our job to be bored to death in any of these meetings, so no doubt about it. Whatever adds to that.
So you want to do that for the next get together?
Sure, and then I think John should just prepare and have them all read, and then give us a full dissertation on all that stuff at the next.
Rob?
I was just going to ask and make sure that I'm kind of hearing the request correctly. We can show portfolios that fall in between these two fishing frontiers, but they're going to look similar, just on a different risk spectrum in terms of the allocation. So,
yeah, I mean, what I'm interested in, I think the way I would put it, is that do all the alternatives, or let me put it the opposite way, does removing an alternative have the same impact on the risk returns?
So that's what was going to be my question. Do we need to show something that has kind of best ideas X private equity, best ideas X hedge funds, best ideas X real estate, something like that, and show a couple of iterations of that?
Yeah,
Is that what,
I think
So, so if you look at them and you say, I'm going to pull one, I'm going to basically constrain one of them out.
Right.
Which is the first one you should constrain out. Then once you've done that, say, okay, now I'm going to constrain another one out.
Yep, okay.
Which is the one that you take out that has the least impact on the optimal point until you're back down to this. So you are gonna have 5 lines that are somewhere between these 2 lines, and the board can then decide, which point on the line you want. You're going to start with 5 alternatives, then you have 4, and the next line, then you have 3, then you have 2, then you have 1, then you'll be down to the bottom.
Right.
And in some ways, I think for us, part of the question that we have to assess is, what do we think the implementation risk is of this asset class in terms of hitting the top managers? Like, do we have confidence in all the alternatives that we have the ability to hit the top managers? Or do we have more confidence that we can do that in hedge funds than we can in opportunistic real estate or vice versa or something like that.
Can you model that?
I don't think they can.
No, not that particular issue. Can I just ask, are you prepared to have 10 lines on this chart? Because if we keep low vol.
Well, if they're all different
for
color, we
every
can
other-
follow it.
That's
Yeah.
fine with us.
Well,
I just didn't know if there was some consensus on low vol.
We have a lot of colors on our PowerPoints.
We'll bring the Crayola pack or padded, 64 colors.
What do you think, Joe?
Why don't we start with 2A and 1A, which, for our work right now, I mean, they're pretty incremental. But include low vol in it for the reasons that John mentioned.
I like the low vol. In fact, I want to go into other funds.
So,
What about low vol equity?
I figured that out already.
so if you include low vol, then you're putting your best team on the field, right?
Yep.
Best team on the field right now is 2A.
Yep.
From a risk reward standpoint.
Yep.
So, let's do that. Keep low vol in the mix all the way down. So we'll go from 2A to 1A. And once we get down to a solution that you all are willing to pursue, then we'll have Sherry redo the calculations on that, and we can compare it to the things she's done already. Because you get the gist of it. There's about $1 billion swing between the two in terms of how much extra, a little more than $1 billion, extra contributions you'd be making as you move down that curve in a bad scenario.
Can I ask a question? On this first chart on slide 2, where would low vol equity fall in terms of risk and return? Or
It would have the same expected return as U.S. equity with about 25% less standard deviation.
Okay.
And we'll show that we can add that as another line.
Yeah, I think that'd be useful.
Sure. I just want to say this is our first time presenting, and so we would like any feedback from this group in terms of what you'd like to see, what you didn't like to see. Obviously, we know to bring printed materials next time, but just want to say thank you, and please share as much feedback as possible so we make these more effective going forward. Thank you.
How do we want to proceed for the next?
When do we want to do the next?
When do we want to do the next one? The next regular meeting is April 13th. My understanding is we might have a very long calendar. So should we wait until that gets distributed before we finalize a time on the 13th?
Well, I would suggest the Tuesday, the 5th, because I think everybody's been holding these Tuesdays, at least I was told to hold them on my calendar in case we had investment issues. I think that would be better than putting it at the end of the disability meeting that's going to be longer than.
Especially after lunch.
Tuesday.
So let me just check.
That's not the sim, right?
No.
No, the sim is
The 20th.
like,
Well,
yeah.
I'm not sure where that date came from, but what if we have?
We used to have investment meetings.
Oh, that was the original, yeah.
Right.
What if we, because we're all going to be there for the sim, what if we tacked it onto the sim either before, had a special police meeting either before or after the sim?
That could be a long day, right?
Well, that's not a quarterly meeting.
No, it's not
Right,
quarterly
that's a
meetings.
monthly, that's a monthly.
It's just it's a special sim where just managers, right? So it's, I don't know how long it is. How many managers do we have?
So yeah, at most you would have 4, so you'd be done by the afternoon. You'd be done by 1 o'clock.
So I'm just thinking you're there already. You probably got it boxed out. So
Yeah, we'll have the camera. We'll have everything.
So that's the
there.
20th?
The 20th we're talking about?
Yeah.
April 20th.
we'll tack it on before or after once the final lineup
And
comes
you guys come for that too, I think, right? Don't you normally come for this?
Yeah.
They do.
Yeah, they would.
Yeah, we'll
They'll
be
be at the
there
sim.
anyway.
Yeah, they would be at the sim.
Okay.
So if that works for everyone, we'll factor that into our timeline for the day.
Is that okay, Rosemary?
Yeah, thank you.
That works a lot better for us.
Okay.
Yeah, because we're already scheduled for it, you just add it onto the agenda.
So do you need a motion to?
So I make a motion to adjourn the executive.
No.
Public.
This is all public? Okay, so then I make a motion to adjourn.
Second.
Second? Great.
All right.
All right, we're adjourned.